Not every amount on a 1099 div is a taxable dividend. On the EA exam, they love testing the fake dividend categories: return of capital, stock dividends, and mutual fund distributions. Your job is to classify it correctly, then track basis. If you miss the basis piece, you'll get the gain wrong later when the stock is sold. Start with non-dividend distributions, also called return of capital. These are not paid out of earnings and profits, so they're generally not taxable when received. Instead, they reduce the shareholder's basis in the stock. On Form 1099 DIV, this is typically Box 3, the trap. Once basis hits zero, any additional return of capital payments turn into capital gain. Here's the clean way to think about it. Return of capital is like getting your own money back, so you don't report income today, but you do lower basis, which increases gain later. If the client can't find their original basis, the IRS doesn't magically forgive it. You still need a reasonable basis calculation. Exam tip: they'll ask what happens after basis is reduced to zero. The answer is capital gain. Next, stock dividends. A true pro rata stock dividend is generally not taxable because you didn't receive cash and everyone's ownership percentage stays the same. But basis still matters. Your total basis in the investment stays the same, and you spread it over more shares, lowering basis per share. The big exception: if you can choose cash instead of stock, the distribution is taxable. Mutual funds add a twist because one 1099 DIV can contain multiple flavors. Ordinary dividends are taxed as ordinary income. Capital gain distributions from a mutual fund are treated as long-term capital gains, even if the investor held the fund briefly. And if the fund invests in tax-exempt bonds, those distributions keep their tax-exempt character. On the exam, they'll test classification more than math. Timing is another favorite test area: declared dividends. If a mutual fund or REIT declares a dividend in October, November, or December, but pays it in January, you still report it in the prior year. The IRS treats it as received on December 31st, so don't let the January cash date fool you. This is basically a built-in constructive receipt rule for these entities. Finally, constructive dividends. These show up on audit when a corporation benefits a shareholder and tries to call it something else. The IRS can reclassify it as a dividend, taxable to the shareholder and not deductible by the corporation. Red flags include the corporation paying personal expenses, excessive salary, unreasonable rent, canceling shareholder debt, selling property to a shareholder below fair market value, or making below-market loans. Which of the following items does not decrease an asset's basis? The options include the cost of defending title to the property, Section 179 deductions, a casualty loss, and a manufacturer's rebate. Think about which one actually increases basis instead of reducing it. The correct answer is the cost of defending a title to the property. That's a capital expenditure, so it increases basis. Section 179 deductions reduce basis. Casualty losses generally reduce basis, and a manufacturer's rebate is tempting because it feels like income, but it usually reduces the purchase price, which reduces basis. Marisol received 500 shares of restricted stock from her employer on March 1, 2023. She forfeits the stock unless she completes 5 years of service. The fair market value on March 1st was $15,000. How much does she include in income in 2023, and what is her basis in the stock? Consider the choices, including reporting nothing until the service requirement is met. Think about it. The correct answer is that she generally reports no income in 2023 and has no basis until the stock becomes substantially vested, meaning she completes the 5 years. The tempting wrong answer is to include the $15,000 immediately, but restricted stock subject to a substantial risk of forfeiture isn't taxed until vesting unless there's an 83B election, and the question doesn't mention one.